Welcome back to part 2 of our series on the Little Book of Common Sense Investing by John C. Bogle. In part 1, we uncovered why most investors fail and why index fund investing gives you the best shot at long-term success. Today, we're diving into something even more dangerous than bad stock picks, the silent wealth killer most investors ignore: fees and costs. These fees might seem small, but over time, they can destroy a huge portion of your investment gains. John Bogle calls this the tyranny of compounding costs. Stick around, because by the end of this video, you'll know how to spot these fees, avoid them, and build an investment strategy that lets your money grow, not get eaten alive by charges. 1. The illusion of high returns. Let's start with a hard truth. The stock market gives, but fees take away. Over the last century, the U.S. stock market has delivered average annual returns of about 9 to 10%. That's powerful. But here's what most people miss. Those are gross returns, not net returns. Net returns are what you actually keep. Once you subtract fees, taxes, and costs, the return you walk away with can be far lower. If you're paying 1% or 2% in annual fees, you're losing up to 25 to 40% of your lifetime earnings from investing. That's not a rounding error. That's your future wealth being drained silently year after year. 2. The cost of active management. Most investors, especially beginners, put their money into actively managed mutual funds. They're sold the idea that smart fund managers can beat the market. But here's what Bogle's research found. Most active fund managers fail to beat the market, especially after fees. In fact, over a 10-year period, 80% of actively managed funds underperform a simple index fund. And over 20 or 30 years, it gets worse. The promise of superior returns is tempting, but the math doesn't lie. These funds charge high management fees, often 1% or more, and tack on trading costs, sales loads, and performance fees. Bogle's advice? Don't try to find the needle in the haystack, just buy the haystack. That means buying a broad market index fund that tracks the entire market for a fraction of the cost. 3. Understanding hidden investment costs. Let's break down the different types of costs Bogle warns us about. 1. Expense ratios. This is the percentage a fund charges annually to manage your money. Actively managed funds may charge 1% or more. Index funds? Often just 0.05% or less. 2. Transaction costs. Every time a fund buys or sells a stock, there's a cost. High turnover funds rack up these costs, and they're passed to you. 3. Sales loads. Some funds charge fees just to buy in, often 3 to 5% up front. Imagine losing 5% of your money on day one. 4. Taxes. Frequent trading leads to short-term capital gains, which are taxed higher. Index funds, because they trade less, are more tax efficient. 5. Advisory fees. If you use a financial advisor or a robo-advisor, make sure you understand what you're paying. Even 0.5% adds up over time. 4. The impact of compounding costs. Here's where things get real. Suppose you invest $10,000 a year for 30 years and earn an average of 8% annually. Without fees, you'd end up with around $1.2 million. Now let's say you're paying just 1% in fees. That reduces your return to 7%. Your final amount? About $944,000, a loss of nearly $250,000 to fees. That's the compounding effect. In reverse, small fees compounded over decades take a massive bite out of your wealth. Bogle calls this the relentless rules of humble arithmetic. The numbers don't lie. The more you pay in fees, the less you keep. 5. The power of low-cost index funds. So what's the solution? For Bogle, it's simple. Invest in low-cost index funds and hold them for the long term. These funds don't try to beat the market. They match it. And because they don't have expensive managers or high trading activity, they can offer fees as low as 0.03%. The Vanguard Total Stock Market Index Fund, for example, gives you exposure to thousands of companies at a tiny cost. Over 20 or 30 years, the difference between a 0.03% fee and a 1% fee can add up to hundreds of thousands of dollars. Bogle believed that minimizing costs is the most reliable way to maximize long-term returns. 6. Why most people still fall for high fees. So if the evidence is so clear, why do so many people still invest in high-cost funds? The answer is marketing and emotion. Financial companies spend billions convincing us that their experts can outsmart the market. They show past performance, flashy ads, and bold claims. But past performance doesn't guarantee future returns. And the data shows that cheap, boring index funds win in the long run.